With the mining sector in decline, the share price of Explosives and Specialty Chemicals Group, AECI, has been under pressure. While it has been building its non-mining businesses, the group still relies on the mining sector for nearly 60% of its revenue. Joining us from our Cape Town studios to discuss the outlook for AECI is Finweek contributor Moxima Gama. Moxima, thanks for your time. AECI, how has this impacted the business, especially when we talk about that mining sector that's under pressure?
Yeah, sure. The mining sector is greatly under pressure, and with the commodity prices still plummeting, it looks like for the remainder of the year, the mining sector could still suffer. But I would assume about next year, it could start weathering the storm. But at this point, we could find a lot of, the mining sector struggling a little, and it's not just that; it's also the strikes and closing off of mines. So it's really a sad story there. But funny enough, or unsurprisingly, AECI is decorrelated to this, and it's kind of held up pretty well over this time.
When it comes to diversification, because they are looking into other revenue streams, how's that been going?
Well, look, they've been clever enough to put their eggs in many baskets. Despite the explosive being the biggest, at least revenue maker, they have kind of explored in other African markets, and they have not just in Africa but also globally, where they have contracts with the recent one with Australia. So that's at least kept their profits abreast. And not just that, they also in fiber specialities and also real estate. So the selling of some of the lucrative land, which to commercial spaces, has at least kept their shareholders happy. So that's helped them throughout this time with the mining sector.
So in a nutshell, the outlook for AECI?
Well, despite my positive outlook at this point with the fundamentals, if you look at the charts, they are starting to look, the share price is starting to look a bit tired. And there is a bit of a bearish consolidation that could end in downside, and that's what we need to watch out for. So despite them being able to decorrelate from what's happening with the mining sector, there's this topping out pattern that's potentially forming, and you'd have to really watch that 102 level. And besides that, this descending phase would then start, and that could go all the way to about the 87 mark. So if you are heavily invested, and they've done pretty well to keep their shareholders smiling, at this point, this sideways pattern that's been going out since November is signs of weakness. And you probably really want to reduce your position around the 102 mark, so you don't have to at least get caught up in that downside that could potentially happen, or that descending phase. And this would be merely on the fact that the share price is extended, not necessarily what the mining sector is doing, as we have seen over the months.
Moxima, thanks so much, as always, giving your insights on a particular stock there. That was Finweek contributor Moxima Gama. Up next, let's unpack this week's cover story.